I'll be reading a statement on behalf of Governor Eli Remolona. At its meeting yesterday, the Monetary Board decided to keep the BSP's target reverse repurchase rate unchanged at 6.5%. Thus, the interest rates on the overnight deposit and lending facilities were kept at 6% and 7% respectively. The Monetary Board noted that the outlook for inflation was broadly unchanged. The latest risk-adjusted inflation forecast for 2024 is to 3.9% from 4.2% in the previous meeting in December. For 2025, the risk-adjusted inflation forecast is relatively steady at 3.5% from 3.4%. Equally important, the BSP's latest survey of external forecasters show the inflation expectations to be more firmly anchored, with the mean forecast remaining within the target range for both 2024 and 2025. Meanwhile, the risks to the inflation outlook have receded but remain tilted towards the upside. The upside risks to the inflation forecast are linked mainly to higher transport charges, increased electricity rates, higher oil and domestic food prices, and the additional impact on food prices of a strong El Nino episode. On the other hand, the implementation of government measures to mitigate the impact of El Nino weather conditions is the primary downside risk to outlook. Given the salience of rice prices, the recent agreement with Vietnam to secure rice supply over the next 5 years is encouraging. Moreover, the efforts to increase productivity in the rice sector, including the distribution of drought-resistant seeds, are a step in the right direction. The sustained expansion in output in Q4 2023 reaffirms the BSP's view that the country's growth momentum remains intact over the medium term. However, recent indicators also suggest that economic activity could moderate in the near term as the full impact of the BSP's prior monetary policy tightening continues to manifest. In consideration of the prevailing risks, the Monetary Board deems it appropriate to keep the BSP's monetary policy settings unchanged in the near term amid the improvement in inflation conditions. The BSP also continues to support the national government's non-monetary measures to address supply-side pressures on prices and sustain the disinflation process. The BSP remains ready to adjust its monetary policy settings as necessary in keeping with its primary mandate to safeguard price stability. End of statement. Thank you.
Thank you, Secretary in Charge Sikat. At this point, we would like to request Director Lapid to share with us the February 2024 Monetary Policy Report.
Thank you, Alicia. Good afternoon, everyone. So this is a short presentation, summarizing the key considerations that went into the Monetary Board's latest monetary policy decision. A more detailed discussion of the points that we'll be showing you shortly it will be found in the Monetary Policy Report, which we are publishing tomorrow and will be available on the BSP website by tomorrow. I think we're also giving out handouts to members of the press who are on site today. So to begin, firstly, our inflation forecasts are slightly lower for 2024, and this is in recognition of the risk partially diminishing, especially for this year. So in this slide, you can see on the left-hand side, the latest baseline inflation forecast of the BSP. So those are, I think you would call them broadly unchanged. But if you look on the right, which are the risk-adjusted forecasts, which incorporate all of the various risks that we're able to identify surrounding the baseline projections. So on top of the baseline projections, so you'll see that we have a lower risk-adjusted forecast for 2024, and a slightly higher risk-adjusted forecast for 2025. So as you can see, so the latest forecast for baseline forecast for 2024 is 3.6, and 2025 is 3.2%. And then for the risk-adjusted forecast, the latest projection for 2024 is 3.9%. So now, it's now within the 2 to 4% government target compared to last time back in November, and 3.5% for next year. The forecast path has been revised on account of the lower than expected actual inflation for December and January. Some relative appreciation of the peso since November, and also the lower path for global crude oil prices. And these were partly offset by the higher assumed path for global non-oil commodity prices, and stronger domestic growth outlook, the impact of the El Nino weather conditions. We'll talk about that more later. And also the minimum wage adjustments in areas outside of NCR. Next, so we show you the path for year-on-year inflation for this year and for next year. So the fan chart on the left shows the relative distribution of risk around the central projection or the baseline forecast, which is the dark middle line. So if you look at the chart, the blue bands are on top of the central forecast, are much thicker. So while we recognize that the risk have diminished, especially for this year, we also continue to see, the Monetary Board also continues to see the risk to the baseline projection as being still weighted towards the upside. So that we show that through the thicker bands in the fan chart. And we've listed also the various upside and downside risk in the table on the right. So these upside risks include things like higher power rates. This is mainly related to the July 2023 Supreme Court decision, nullifying or reversing the ERC 2014 ruling to cap the WESM rates back in 2013. Other upside risks include the potential impact of higher transport charges. These are based on existing petitions for increases in jeepney, MRT3, and also taxi fares. We've also the risk of higher oil prices due to an escalation of conflicts in the Middle East. This is originally based on a broader scale of conflict within the region arising from the Israel Hamas conflict, and also the recent Red Sea attacks in Yemen. And other upside risks include the possibility of higher domestic food prices as a result of continued supply constraints for commodities such as pork, poultry, fish, and sugar, and other items. And then last one is the additional impact of possible further declines in crop production, particularly for rice and corn due to strong El Nino conditions. For this one, we've assigned a low probability based on the latest climate outlook from Pagasa, which indicates that the strong El Nino episode will be mostly confined to the first quarter of this year, and we're likely to see ENSO neutral weather conditions by the middle of this year. Then the downside risk to the inflation outlook consists of the impact of government measures to mitigate the El Nino dry weather conditions on agricultural production. And next, we look at other considerations that were discussed by the Monetary Board. That includes inflation expectations. And so we show here the mean forecast or the average forecast provided to us by economists who are participating in our survey of external forecasters. For this round, for February, we received responses from 24 economists. And so the mean forecast is unchanged from between January and February at 3.9% for this year. For the forecast for next year, the mean is slightly higher at 3.5 versus 3.4 back in January. And then for 2026, so we've started just this year asking economists about their 2026 outlook. The mean forecast is unchanged at 3.4%. We in the survey, we also ask about their views on the upside and downside risk to inflation. So some of the upside risk identified by the economists include things like increases in potential in basic goods, particularly oil and food, and especially rice. Higher prices of services also, particularly for restaurants and accommodation. The adverse impact of El Nino and also geopolitical conflicts in the Middle East. Some analysts also cited the possibility of second round effects in the form of wage adjustments and also higher electricity fares, and as well as positive base effects in the middle of the year. And I think we try to account for that also if you look at the previous chart on the fan chart on slide 3. So our own baseline forecast shows us an uptick in inflation in April to July, and that's largely a function of the positive base effects on in CPI because of the low food and inflation in last year. Sorry, so to continue, we apart from looking at the mean the inflation expectations, we look at also the overall distribution of the forecasts that we've received. So if you remember a typical bell curve, so the chart on the left shows the distribution of forecasts for 2024. The red line is the November 2023 distribution, and then the latest one is the blue one for February. So you can see if you compare the two curves, there's been a shift in inflation expectations towards the left, meaning that the forecasts that we're getting are more concentrated to the 3 to 4% range. So that to us suggests a gradual re-anchoring of inflation expectations towards the government target. So if you look at the February curve, it's also much thinner. So there's less uncertainty being seen by economists in our survey. And you can see a similar pattern also for 2025. Although for 2025, I think back in November, there were, I think, a handful of economists who were still seeing 2 to 3% inflation. So for this round, I think the views or the forecasts have solidified around the 3 to 4% range. So again, that to us speaks of inflation expectations, at least from the external forecasters in our survey, as being becoming a little more anchored towards the target and being more focused on or closer to the upper range of the target. Next, we look at so the Monetary Board also discussed the prospects for domestic economic activity, and based on the recent data on domestic demand indicators, the view is that firstly the Q4 GDP numbers were within our nowcast for the quarter, and the expectation is that based on the recent data that domestic recovery is likely to continue in the next few quarters. Although the discussion did also include the likelihood that most of the impact of the monetary tightening that the BSPS has undertaken so far would largely fall on 2024 domestic activity. So that's something that will be closely looked at. And then so to briefly summarize, so what we've seen is that the risk to inflation have diminished, but they are still mostly concentrated on the upside. So that argues for a bit continued caution on the part of monetary policymakers. So in consideration of the prevailing risk to the inflation outlook, the Monetary Board decided that it would be appropriate to keep the monetary policy settings, meaning the overnight target for the the target for the overnight RRP rate unchanged for the time being, even as conditions for or inflation dynamics continue to improve. And secondly, as we said, we mentioned, the risk to the inflation outlook are still seen as being concentrated on the upside. Inflation expectations, as we've seen, are mostly steady and are increasingly being re-anchored to the target. Domestic activity is seen to remain intact over the medium term, with continued signs of recovery based on recent demand indicators. And as we've heard from the monetary policy statement read by SAG CCAT, the BSP remains ready to adjust its monetary policy settings in response to the risk to inflation in order to safeguard price stability. So that is the presentation. We'll be publishing the monetary policy report tomorrow on the BSP website. It's available for download. We just want to briefly note that the monetary policy report, apart from the discussion of the forecast, I should mention also that we provide in detail the discussion of these latest forecasts, because this is a full update of the forecast, because we have GDP and CPI data for this round. So in addition to the detailed discussion of the forecast, we also include 2 box articles featuring research by my colleagues at the research department. This includes a box article on second round effects of supply shocks and inflation, where we discuss the impact of things like oil price shocks and food price shocks and how they affect inflation expectations. We also have a second box article on something developed by the staff, which is a Philippine Supply Pressure Index. So this looks at supply chain pressures that may affect inflation. So we look at things like pressures that involve pressures on inventory, for example, and also pressures on logistics. And we construct an index to try to measure those pressures. And those, based on our preliminary work, appear to be have some predictive content for headline and core inflation. So that is the summary of the report, where we look forward to your questions.
Thank you, Director Lapid. We now proceed to the questions from the press and our invited market analysts. This will be the order of questions. First, we will entertain questions from in-person attendees from our BSP press corps. Next, questions sent in advance, and then last, online or any additional questions. So we will begin with reporters who are here today. Reminder, please to raise your hand and wait for the microphone to be handed to you. Kindly state your name and identify your media organization before asking your question. Thank you.
Hi, good afternoon. Ditas Lopez from Bloomberg. Governor Remolona earlier said that a rate cut is possible within the year, but probably not during the first half. Given the receding inflation risk and the anchoring of inflation expectations, is there room for monetary easing to be accelerated or a rate cut to materialize earlier than initially expected? Thank you.
Based on the report earlier by OIC Dennis, he stated and clearly emphasized that the risk to the outlook, inflation outlook, remains tilted to the upside. And therefore, while we see some improvement already in the inflation, both headline and core, we still consider taking a more prudent monetary policy stance at this moment. As soon as we get a firmer indication that inflation trend will be going back to the target range, there could be scope for a rate cut. But at this moment, given the substantial risk on the upside, we consider the policy rate at the moment appropriate to maintain.
Thank you.
Thank you, ma'am.
Good afternoon. Mikael Flores of Reuters. On the flip side, as you mentioned that the monetary policy settings remain appropriate, can the or is the BSP of the view that it is done with a tightening cycle, given that inflation risks has receded and uh, the 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 interest, the benchmark rate will be kept as it is in the near term?
Every time the monetary board decides on the monetary policy stance, it considers not only the outlook and the risk that accompanies the outlook, inflation outlook, as well as the impact on the economic growth. So at the moment, given all the upside risk that was mentioned earlier, that if it materializes, then the outlook of inflation remains to be on the upper end of the inflation range. So at this moment, we will have to consider all the available information before a possible rate cut is considered.
Just a quick follow-up, because I think from the last policy meeting, the inflation path it will be within the target band in the first quarter before, due to base effects, before you see some inflation rate that will reach a target due to the effects of El Nino in the second quarter. Is that still the case, or have you seen some changes based on your inflation forecast?
Based on the fund chart that was presented earlier, the path remains the same. I mean to say there will be easing of inflation during the first quarter, mostly because of the base effect, but we'll see some uptick maybe beyond the inflation range by the second quarter, but it will revert back to the target range by the third and fourth quarter.
To be clear, the base effects are expected to be negative in January and February, but they will turn positive in March and some succeeding months. So, which is why if you look at the fan chart, we also try to show an uptick. So there's a possible increase in inflation in April to July. So I think that also it influences or is a major reason for the continued focus on inflation in monetary decision making.
Last question, my end. In past statements, the BSP has emphasized that it will keep policy settings sufficiently tight until it sees a sustained downward trend. And obviously, because of the base effects that we will see and the effects of El Nino, we will see a slight uptick towards the second quarter. I'm curious, what, in the view of the BSP, what would constitute a sustained downward trend in inflation? Because obviously we will see an uptick.
Yeah, if we see that the risks that are identified here, the probability of it, declining, like for instance here, we present some of the probability we assign to certain risks. Say for higher electricity rates, we assigned a high probability of it materializing. So, and looking at the other risks as well. So if we see that the risk to all these identified events will be reduced, and also the path of actual inflation continue to show deceleration as we see last December, continuing on to January, there might be some consideration for a change in monetary policy stance, probably. But at the moment, given all the information that we have on hand, we think that maintaining policy rate is the appropriate stance.
Thank you. Next question, please.
Hi, good afternoon. This is Keisha Taasan from Business World. Ma'am, just to follow up on what you said, that as soon as a firmer indication of inflation trend going back to the 2 to 2 to 4% target range, there is a scope for rate cut. But the BSP lowered its risk-adjusted forecast to 3.9% within the 2 to 4 target. So how would this affect future policy decisions, especially in the first half of the year?
Um, Earlier, it was presented what the risk-adjusted inflation forecast is. And for 2024, the outlook is at 3.8, which is still at the upper end of the inflation range. So given, and plus the fact that there are still risks that, we see that could happen and further push inflation out of the target range. So I think if we see some improvement, then there could be some consideration. So basically, we look at the domestic developments, barring any further shocks that could affect inflation trend in the future.
Ma'am, another question on inflation. Yesterday, the Senate approved on second reading a bill that is calling for a 100 peso increase for the minimum wage in for workers in the private sector. How would this affect inflation in the near term if it was approved?
We have in our baseline projection, we incorporated in our baseline projection the agreed adjustments in minimum wage. Now, to the extent that the assumed increase in minimum wage is beyond what we have incorporated in the baseline. And if you notice, it's not part of the risk adjustments that we presented. This could pose a threat to our inflation outlook in the future.
And last question from me. You in the BSP policy statement, economic activity could moderate in the near term. So how do you, or is there a growth forecast for this year, 2024?
The impact of policy adjustment will now be felt, by the rate of growth in the economy. And that's the reason why we emphasize that there could be some moderation in level of economic activity. But we think that we will still pose a modest economic growth for 2024.
Last question. Would this growth forecast be below government target, 6.5 to 7.5%?
Actually, when we do our forecast, we do not incorporate any reforms or initiatives that the government will undertake. So even the government, I think, when they do their forecasting, they have a baseline level of what growth would be, and then based on the baseline, they will put in. If my target is, say, like government's target for this year is 6.5 to 7.5. Right? So if my baseline is below that 6.5 to 7.5, then they will have to do some interventions to increase to make economic activity stronger, so that they could achieve the target. So we need to have a notion of what is the baseline forecast, which is what we're doing, and what is the target, which will incorporate the initiatives, reforms that government needs to undertake in order to bring it up to the target level.
I think in the report we indicated that growth is going to be slightly below potential, and so we expect a small negative output gap going forward. But that's to be expected, because that is precisely the intended impact of monetary tightening, which is to curb demand in order to slow down inflation. But I think the basic point still stands, that the domestic economic activity will still continue to be intact over the near term.
Thank you.
Next, please. Ma'am, sir. I'm Kai Ordinario from Business Mirror. Are there factors or events that could push back or delay rate cuts or even postpone rate cuts to 2025? If any, what could these factors be?
We listed down some events that could put, inflation at risk. If some of the probabilities assigned to these events would be higher than what we expected, plus if there are other events globally happening and that would spill over into the economy, and there are, we also factored in assumption on El Nino, but we made some assumptions. But if it turned out that the impact of that on our production would be far more worse than we anticipated, then that will weigh on our inflation outlook in 2024 and can affect, decision for policy stance.
Thank you.
Good afternoon. Hi, sir. Victor from GMA. You mentioned about economic growth, just going back to that. It was said that for this year, the impact of the lag impact of the previous tightening will be felt. Just wanted to ask when the peak will be this year and how big of an effect will this have on economic growth?
Based on our econometric exercise, the impact of policy adjustments to economic growth is, correct me if my recall is wrong, it's 5 to 6 quarters. 5 to 6 quarters. Yeah, but maybe, the events that transpired in 2020 up to now is different because we're looking at, past data. Based on our past experience, our observation shows that there would be some impact 5 to 6 quarters later. But given the magnitude of the events coming from the pandemic to now, that could, the impact could be a bit longer.
We have time for one last question.
In your discussions, were there any mention of how the BSP will move in relation to how the Fed will also act regarding the monetary policy?
We've always emphasized that, monetary decisions of the BSP will always give far more weight on domestic events than on, what other authorities in advanced economies would take. So, while inflation conditions at the moment has improved, it provided us some scope actually to have monetary policy adjustments even faster than, other advanced economies are undertaking. But then the question here is, whether the timing of adjusting policy rate is optimal at the moment. So even if the U.S. Fed will, their rhetoric says that their adjustment will not be earlier than May. That was their rhetoric. So at this juncture, it's really difficult to say at the moment because we are facing different challenges. U.S. has strong labor conditions. We do also, but then again, if you look at our inflation, it's emanating more on the supply side, not on the demand side. So we need to evaluate all the things before, we take any policy action. But at the moment, as what the governor has said, we will give more weight on domestic events, but we will also consider what's happening abroad because that would also have an impact on financial market here, which could also threaten or disanchor our policy expectations, inflation expectations.
Also, maybe just to add, the baseline projections already include some assumptions on the Fed funds rate. So we normally make use of the Fed funds futures data. So the baseline forecasts incorporate the views of the market based on Fed funds futures data as of early February. So this is consistent with the current market consensus view of the Fed holding steady until April of this year.
Just a short follow-up. Ma'am Lu, you mentioned the improved CPI outlook gave you a little a scope to discuss monetary policy changes. So, am I correct to assume that that's a rate cut? And is it the first time that you're able to do that in this cycle?
I didn't quite get the question. Can you repeat
Ma'am,
that
you
again?
mentioned in your answer to my question that the improved inflation situation gave you a little more scope to discuss monetary policy changes. So even ahead of other central banks. So
No, what I'm saying is that should there be sustained improvement and actual inflation, and our outlook, inflation outlook, continue to show deceleration, moving towards the target range, there could be scope, I said, but I'm not saying,
last na lang, ma'am. Sorry, I understand. And then lastly, the central bank has been hawkish for the past few months. Is that still the case now?
we always, when we do our policy decision, we not only look at the baseline, we look at what are the risks. So that's more or less our basis on, what our view would be, whether we continue to take a hawkish view, or like in this case, I think we showed already that the risks sort of improve as compared to what we presented in December. But then again, there are other risks that could offset, inflation outlook. And so we need to maintain our hawkish position. But in terms of tone, it's not as strong as what we had last December. But we continue to be hawkish, looking at developments here and abroad.
Thank you so much.
So just to add, in other words, I think the Monetary Board recognizes that inflation conditions have improved in the sense that actual inflation is going down. Our forecasts have been adjusted downwards, but at the same time, as we've said, the balance of risk is still on the upside. And if you look closely at the fan chart, we still have a more than 50% probability of above 4% inflation for this year. And even our risk-adjusted forecasts are still suggesting that inflation may still go over the target. So I think those are the things that maybe are sort of the basis for the overall hawkish view.
Thank you so much. Next, we will go to the questions that were sent to us in advance. And then for our online media friends and as well as our market analysts, you may send your comments to our live Facebook broadcast or message us through text, Viber, or Messenger. So first question is from Michael Ricafort of RCBC. How would RRR cuts be possible later in 2024 amid easing inflation?
Okay. Well, certainly the inflation and inflation expectation, as has been reported, has been reduced as compared to the earlier assessment of the BSP. But then again, it was also emphasized that there are risks that are more tilted to the upside. So given this, I think we think that the timing of the RRR should be considered once, the risk that we have identified has further receded, and trend to target range is maintained over the period. So, but nonetheless, having said this, the BSP continues to maintain its commitment to reduce RRR level at the rate comparable to our neighboring countries in the region.
Thank you. We will skip the question on the federal rate cuts because that was already asked. From Professor Emmanuel Lopez of Colegio de San Juan de Letran, local rates have reached an all-time high of almost 7% in December. This is discouraging to investors because of the high cost of borrowing as well as fluctuating equity market, which has been volatile for some time now. On the other hand, this encourages savers. Our inflation rate has shown tremendous recovery over the past few months, in fact, operating within the BSP target. Considering all of these variables, will these be enough to consider lowering interest rates in order to attract FDIs and not merely empty promises called from foreign visits?
Decisions on monetary policy actions are not only based on actual data, but we also look at what inflation outlook would be. And as repeated more than twice already, or more than a number already this afternoon, we have always said that the near-term risks remain to be on the upside. And the primary mandate of the BSP is to ensure that price stability is maintained over the medium term, because that ensures sustained economic growth as well. So we will continue to monitor developments and the risk to inflation, and we will adjust policy rate as necessary once conditions further improve.
Thank you, Sagsikat. We will now move on to our online questions. So first, from Lee Chipongyan of Manila Bulletin. In setting your risk-adjusted inflation forecasts, what are your GDP growth and foreign exchange assumptions for 2024? Your internal targets are usually different from DBCC's.
Exchange rate assumptions are in line. It's a range. Our exchange rate assumption remains to be within the range of no, not 55 to 58. Actually, we are consistent with the exchange rate assumptions of the DBCC. But in our exercise, we do have a point exchange rate level, but that exchange rate assumption is within the range of the assumed rate submitted to the BCC. As to the GDP growth, it has already been stated earlier that our forecast remains to be lower than the DBCC. But of course, our forecast excludes any possible interventions of the government to ensure that they reach that target.
Thank you very much. We received a question from our Facebook page from Mr. Chester Webon Chanko. He asked, Japan just entered into a recession. Will there be any direct effect on our economy?
Probably the impact would be on the trade channel, to the extent that Japan will have lesser demand for our goods. Then that would impact on our exports of not only goods, but probably even services.
Thank you so much.
The baseline forecast also incorporate the most recent projections by the IMF for global GDP growth based on their January World Economic Outlook. We also rely on forecasts from the Global Projection Model Network, or GPMN, in tracing the outlook for global GDP. So to the extent I think that those forecasts reflect the likelihood of weaker economic activity in Japan, then those are included in the baseline projections. But I think the overall view with regard to global economic activities, that the risk of a global hard landing has receded, and that's why we've taken out the downside risk from weaker global GDP growth in our list of risk factors. So, and so in that case, that to some extent we're incorporating already compensating factors such as continued economic resilience in the U.S. economy, for example. So that's also incorporated in the forecasts.
Thank you very much, Tagsikat and Director Lapid, for responding to all of the questions this afternoon. Are there any more questions from the floor? We will do one last. One, okay?
Sir Dennis, if I remember, in the November MPR, there was a mention that growth could settle below the DBCC target because of the lagged impact of interest rate. Is that the BSP's view? And I wonder if in the MPR that will come out tomorrow, that remains the same, and if the growth prospects have further moderated than your last assessment in November.
I think we mentioned that in the MPR for this round, and that's of course that doesn't take into account any measures that might be undertaken by the fiscal authorities in order to try and support or outside the fiscal spending program in order to further support domestic growth. And that's also, of course, the outlook also is conditional on the underlying assumption for our current forecast is unchanged interest rates also. So we will keep current interest rates at their current levels.
Thank you. If there are no more questions, we would like to thank everyone for their time and attention this afternoon, including those watching us live on our FB page. We would like to remind everyone that the Monetary Policy Report will be available on the BSP website tomorrow, the 16th of February, 2024. This ends our Monetary Policy Stance and Monetary Policy Report press briefing. Maraming salamat po.